Well, hello and good afternoon, everybody. Tom Galucci here with the Mortgage Collaborative. Time now is 2 p.m. Eastern and 11 a.m. for those joining us from the West Coast. I want to thank everybody for joining in for today's TMC Connect web broadcast titled Keeping It Simple with the new Jumbo AUS program from our longtime partners at Plaza Home Mortgage. And before we jump into today's discussion, just got a quick couple housekeeping items for the call. Just want to encourage attendees, continually check out Mortgage Collaborative's member event calendar on TMC's website, and you get a great slate of upcoming TMC Connect web broadcasts. And we're constantly updating the future docket on a regular basis, so keep checking in there. Also have a great session immediately following today's broadcast with our partners at Blend, highlighting their LO toolkit. So feel free to jump in for that with us at 3 Eastern. But specific to today's call, whether you've dialed in or you're connected via your computer, all lines have been muted. Don't only to avoid any background noise in your area, just ensure attendees can hear today's presentation clearly. And we want these discussions to be as interactive as possible. So feel free to submit any questions or comments that you have throughout. And you can do so via either the Q&A or chat buttons at the bottom of your Zoom screen. And I'll be able to verbalize those on your behalf with our discussion leaders towards the end of the discussion today. Highly encourage you as well, send us any comments. Let us know where you're calling in from, or, anything related to what you're hearing about that you want to learn more of in relation to Plaza's Jumbo AUS offering. As a reminder too, today's call will be recorded, will be available for playback. So instructions to access copy, as well as copy of the presentation deck, will be distributed to all registrants and attendees in a follow-up email that you should receive tomorrow. So for today's discussion, as I mentioned, our longtime partners at Plaza Home Mortgage, actually TMC's most tenured correspondent investor partnership, are here with us to share more about newest product offering, their Jumbo AUS program, really designed to make jumbo lending simpler for mortgage lenders. And great slate of subject matter experts and discussion leaders with us from Plaza. First off, for today's discussion, we have longtime friend of mine, Selby Mayer, who is the Senior Vice President of National Correspondent Sales. Hey, Selby.
Hello.
Hello. Nice. Always great to have you with us. Also leading today's discussion, going to be driving a lot of the discussion around the Jumbo AUS offering, is Rich Martinson, Senior Vice President, Secondary Marketing with Plaza Home Mortgage. Hey, Rich.
Hey, Tom. How are you?
Doing good. And then for the guru for more technical or underwriting related questions that you might have here, we've got AVP of National Correspondent Underwriting at Plaza, Jason Kotz, joining us as well. Hey, Jason.
Hello.
Awesome. Well, before just looking to turn it over here, we're really excited to provide the TMC membership this information on Plaza's new Jumbo offering. As we know, it's a continual wish list item for lenders to kind of find optimal takeout options with their Jumbo volume. So before we jump in, I want to kind of turn this over to Salpi. Salpi, if you would just, take a brief moment or two, kind of highlighting maybe some of the key differentiators or some of the key benefits that TMC members can experience in partnering with Plaza on the correspondent side for those that aren't already working with you.
Sounds good. You got it, Tom. Thank you, first of all, again, for co-hosting this with us. We really appreciate the time, and thanks to our listeners and our audience today. So thank you for joining. We hope you get a lot out of this Jumbo AUS training. But for those of you who know us, obviously you know all the things we offer, the diverse product mix and our certified program. And for those of you who don't know us, Plaza has been around since 2000. We started off as a wholesale company and evolved into added to our correspondent division in 2012. And then from that point on, we also added a consumer retention division as well. So we have all three channels, and we're really excited to work with different partners in all those channels, as well as borrowers. We have been able to purchase loans from all 50 states, both bulk and best effort. So we're excited about that. And also, as a investor, we can buy pretty much any loan program, conforming, FHA, all ranges of conforming FHA, VA, USDA, renovations, one of our more popular ones, reverse mortgage, programs as well. And then Jumbo, which is what we're going to focus on today. Our most recent addition is the Jumbo AUS. So we're thrilled to have that program and introduce it to you guys and go over it with you. And all these programs we offer, for the most part, any delivery method is good. For our conforming FHA, VA, renovation, we can do best effort, single loan mandatory, bulk AOT. We also allow delivery of delegated and non-delegated as an offering to assist in your business needs. So we really offer a lot. And like I said, we're really excited to go over the Jumbo AUS today. But I would say the biggest differentiator for us, for those of you who don't know us on the correspondent side, is our certified loan program, which goes on every single loan that we purchase from you. So nothing for you to choose. It just goes right there. There's no upfront cost. So we're really excited about that because that program protects you from buyback demands due to manufacturing defects, underwriting, processing errors, compliance, occupancy, income, appraisal, you name it, is offered under this certified program for our correspondent loans. So I would say that's our biggest differentiator if you had to pick any, but along with our diverse product menu. So really that's in a nutshell, who we are. At the end of the day, if I had to sum it up, we're here to do business with you based on your needs and what you as a company, and we'll customize it to that. So, but today we're going to focus on the Jumbo AUS, like I said, and without further ado, I'm going to hand it to our great subject matter expert on that, and that's Mr. Rich Martinson. So Rich, without further ado, the floor is yours.
Great. Thank you, Salpy. And again, thanks everybody for joining. We're excited to go over this new program with you. It's a really great program, a long time in the coming. So let's see, let's go to the next slide. So today we're going to talk about the new Jumbo AUS program, talk about the opportunity it offers, its benefits. We'll go through the guidelines. We'll compare programs to our other Jumbo program, and really that comparison works as a good proxy for comparing the Jumbo AUS program to the more traditional Jumbo programs you're used to. So it serves a couple purposes. We can talk about our two Jumbo options, where one might work, where the other won't. And it also really helps to highlight how Jumbo AUS is different from the traditional Jumbo programs you're used to. And then we'll talk about some Plaza resources on our website and then open it up for questions for you all. So what is Jumbo AUS, or what does it offer? It's a new Jumbo opportunity. Jumbo AUS uses DU and LPA documentation. It's easy to use and it prices out very competitively. Really the key is it's easy to use, and it really opens up Jumbo eligibility to borrowers that may not have qualified before. The key to this program is it uses the new QM definition, which no longer relies on Appendix Q to be a qualified mortgage. It no longer relies on a DTI cap of 43% to be a qualified mortgage. It uses that new definition, and what that allows really is you to qualify for a Jumbo loan using Fannie Mae and Freddie Mac documentation. So in the past, all the conforming loans, there are so many scenarios where a borrower could qualify for a conforming loan, but if they needed a loan amount above the Fannie and Freddie limits, they'd have to go to Jumbo. And if they didn't meet Appendix Q guidelines, they are immediately thrown into a non-QM program. This solves that problem. So now, if assuming a borrower could have qualified for Fannie or Freddie program, but they need a Jumbo loan amount, now they likely can qualify for the Jumbo loan amount on this program, and they'll get that great, prime Jumbo A pricing. This is a QM prime Jumbo program. It's not a non-QM program in any way. It's not an alternate program. This is prime, QM, Jumbo A, just using the new QM definition, which allows us to use Fannie and Freddie documentation and LP, A, and DU. So that's the opportunity, or the difference in a nutshell. Figured the best way to show the differences would be to compare our new Jumbo AUS program to our other Jumbo program, Jumbo 1. And the Jumbo 1 program is really a typical Jumbo program using the original QM definition from years past, or the original QM definition. Jumbo AUS, both Jumbo Prime programs, but of course Jumbo AUS uses that new definition. So going through this comparison, and I'm going to go through it pretty quick, mainly pointing out the things that are different due to the difference of QM definitions, the new versus the old. There's a few other things that are a lot nicer on this program I'll point out, even though they might not be relative to the QM definition specifically, but they're great, so I can't help pointing them out. But anyway, for the things I don't touch on here, this deck is available as a handout after the call, and the next two slides are a good reference for you to look at the differences in our programs. But anyway, a few things I want to point out here. The first is the QM designation. These are both QM Safe Harbor programs. The new Jumbo AUS is a QM Safe Harbor program. The difference is in the documentation, really. So on the new Jumbo AUS, we document and verify using DU and LPA. And for those items not addressed in DU or LPA, we go to Fannie Mae and Freddie Mac guidelines. You know, a traditional Jumbo program would require you to go to Appendix Q and have that 43 DTI max. Jumping down to FICO, just show they're both 680 FICO programs. Again, this is not an alternate program or something that's much more expanded in the sense of non-QM. It's a QM prime program. Looking at, I guess the last thing I want to point out on this slide before we go to the next is the eligibility matrix. Not specific to the new QM definition, but this program does have an expanded eligibility matrix compared to the traditional Jumbo programs. We do go to higher LTVs. Overall, we go to 89.9, and we do go to higher LTVs at certain FICO scores and loan amounts relative to more traditional Jumbo programs. Let's go to the next slide. The next slide really shows, or this slide shows the main differences, one to point out in the new program. So for trade lines, we go to DU or LPA for trade line requirements. You know, traditionally you're looking at, you know, how many trade lines have been open for X amount of time. You're counting 2 or 3 trade lines. No need to do that on this new program. If DU or LPA give you an approve, you're fine regarding trade lines. Income and employment documentation, we touched on that, but again, DU or LPA for the income and employment documentation, even if it happens to be less than 2 years that need to be verified, that's acceptable on this program, whereas a traditional program would require Appendix Q. You know, looking at self-employed borrowers particularly, they're generally the most challenging on Appendix Q or QM historically. For self-employed borrowers, we can use DU or LPA, income and employment documentation. And again, even if it's less than 2 years that DU or LPA are asking for. You know, and traditionally you need that 2-year tax return history, P&L, and balance sheet. We do not need all of that on this program. Really, again, just per DU and LPA. One little caveat, you know, Fannie and Freddie currently have that overlay due to COVID for an audited P&L or a borrower prepared P&L with 3 months business bank statements. That does apply on this program as well, but again, it's the same as the Fannie and Freddie requirement. DTI, 45% DTI, so no longer capped at 43% DTI. Non-occupant co-borrowers are allowed on this program, not allowed on a traditional Appendix Q program. We can do non-occupant co-borrowers here. Assets and minimum borrower contribution, this is really nice. Again, it's per DU or LPA/Fannie Freddie. Primary residence borrowers could potentially have no borrower contribution, and all gifts could be gift funds. Traditional programs require at least 5% of borrowers' funds. And reserves on this program are greatly reduced as well. Not specific to the Appendix Q, the QM definition, but just something I want to point out because it is a big difference on this program. And this program does allow reduced reserve requirements compared to traditional jumbo programs. And multiple finance properties, again, per Fannie or Freddie. So a primary residence could have up to 10 finance properties. Typically, you run into a maximum of 4 on traditional jumbo programs. So that's what I wanted to go through on the comparison. Again, this will be available in the handout after if you want to look at each line item. Now we'll go through a program summary, just kind of go through the program in general, kind of start to finish. Loan amounts. So the loan amounts are $548,251 to $2 million. This is a true jumbo program. So if the loan's eligible for a high balance or a super conforming loan based on the property location, that would not qualify for this program. These loans are true jumbos and they need to be approved ineligible for loan amount only. Again, they're full doc qualified mortgages. Want to make sure this is clear. We're using the new QM definition. These are QM loans. They're not non-QM loans. Again, there's no max 43 DTI under the new definition. There's no Appendix Q under the new definition. And yes, under the new definition, we can document per DU and LPA, Freddie, Fannie guidelines. Clauses offering currently 15 and 30-year terms on this program, fixed rate, minimum FICO down to 680, 45% DTI. And that 45 DTI is nice. In the guidelines, it's very simple. It's just 45 across the board, no footnotes to look at. Whatever the scenario is, we allow up to 45 DTI. Reserves are greatly reduced. Primary residence, second home, and investment property are all eligible. Purchase, rate, term, and cash out are eligible. And we allow the typical properties, attached, detached, single family residence, PUD, condo, and 2 to 4 units. Transactions, purchase, rate, term, or cash out. Nothing unique about the way purchases are handled on this program. A few things to point out on refis. On a rate term, 6-month seasoning is required if the prior transaction was cash out. If the prior transaction was a purchase, no seasoning requirement. Of course, we would have the seasoning on the valuation, but you could do a rate term quickly. Rate term does allow the payoff of a seasoned, Rate term allows the payoff of a seasoned second, including a HELOC. So this is one area that does not follow Fannie and Freddie, but it's to our benefit. So you could pay off a non-purchase money second in a rate term on this program. And just a heads up, the max cash back on a rate term is $2,000. So you cannot go to the 1%. It's max $2,000 cash back, regardless of what percent that is. On a cash out, 6 months ownership seasoning is required. And the appraised value may be used after 6 months. That applies to both rate term and cash out, but we put it under the cash out bullet just because it's pretty unique there. So if they've owned the property 6 months or they had 6 months seasoning since the last transaction, they could do a cash out and they could use the appraised value. In Texas, 50A6 or Texas cash out transactions are not eligible. Some more on refis. So delayed financing is allowed. So for those cash outs where the borrower purchased the property within cash within the last 90 days, those do qualify and are allowed without the 6-month seasoning requirement. And that's allowed for the first 3 months after the original cash purchase. Again, the refi is based on the LTV after 6 months of ownership, not 12. And for refis, properties cannot be listed at time of application for a rate term, and we don't want to see any listings in the last 6 months for a cash out transaction. Nice for paying off of a construction loan. The borrowers only must have been on title for 6 months. And on a construction loan, we are looking at 12 months seasoning before we can use the appraised value. If they've been on title or owned for 6 months but less than 12, we can still do it. But the LTV is based on the lesser of acquisition or appraised value. Property eligibility, this is quick and easy, but attached, detached, SFR, PUD, condo, max 20 acres. Everything needs to be residential in nature. 2 to 4 units are allowed. And on condos, they're easy. Just document, verify eligibility, and warrant per Fannie and Freddie guidelines. No overlays there for condos. Appraisal, one full appraisal is always required. So if DU or LPA give you, an ACE waiver or an appraisal waiver, we cannot accept that waiver. We do need a full appraisal in each case. Transferred appraisals are not allowed. And this is good. We only need one appraisal regardless of loan amount. So all the way up to $2 million, purchase, rate, term, or cash out. One appraisal is all that's required. And a CDA, collateral desktop analysis, it's an appraisal review. You might be familiar with it if you do other jumbos. Most jumbos require it. But anyway, an appraisal review is required on all loans. Plaza will order that, or you may order it yourself and provide it to us in the closed loan file. That's a CDA from Clear Capital. And what's nice on this program, if your CU score is less than or equal to 2.5, we waive the CDA requirement. So we need an appraisal review unless your CU score, the collateral underwriter score that you get on the appraisal that gets delivered typically to Fannie. If that score is under 2.5, no appraisal review required. So shifting over to borrowers, borrower eligibility, pretty standard for a jumbo program. U.S. citizen, permanent resident aliens. Non-occupant co-borrowers, though, is typically not eligible on a jumbo. We can do it here. And a first-time home buyer is fine. We just have a few caps there, max $1.5 million loan amount and a max 80 LTV on a primary. And then ineligible borrowers. Typical borrowers must be a natural citizen, so no natural person, no LLCs, corporations, or partnerships, and borrowers do need a valid social. Pretty standard. On the next couple slides we're going to look at are from our product matrix and the program guidelines. Just wanted to put those up so you can get a look at them if you haven't seen our guidelines. But a few things wanted to point out here. So LTV is up to 89.9 with a credit score as low as 700. And with that 700 credit score, you could also go to our max loan amount of $2 million. And then with a 680, you can go up to $1.5 million with an 80 LTV. So, that's generally where most jumbos land, in that up to $1.5 million, 80 LTV range. So with a 680 FICO, you can do all that. And with a 700 FICO, you can hit the max. You can hit the max loan amount, max LTV. So 700 FICO is a good, relatively low score for those qualifications. Just the footnotes we already talked about on first-time home buyers. Look at the next slide. So cash out refi, you can go all the way up to 80 LTV on a cash out with a credit score as low as 680. Again, 700 is kind of the magic credit score. Once you have a 700, you can go to the max loan amount of $2 million on cash out, and you could go to the max LTV of 80% with a 700. Well, sorry, 680 FICO gets you up to 80. With 700, you can do whatever is in the matrix and offered. And notice the max cash outs per AUS. There's no cash out limit. So as long as you get that approved and eligible and you're doing cash out, you can get as much cash out as the AUS allows. And I didn't point it out in these tables, but you'll notice on the right, the DTI column, all the DTIs are 45%. There's no asterisk, no footnote. All these transactions qualify at 45 DTI. Second home up to 80 LTV with a 680 FICO, and we do allow up to $2 million on a second home purchase or rate term. Second home cash out, we can go up to 75 LTV on a second home cash out with a 700 FICO. And here we do need over a 700 FICO to get the max loan amount. Don't expect to see a lot of second home cash out transactions, but offered and available. And investment property, purchase and rate term and cash out allowed on investment. The LTVs are lower as expected, but we do allow a cash out on an investment or a purchase and rate term. You see the 700 FICO there. So credit, we touched on most of these things, but want to make sure they're clear. So the underwriting method, DU and LPA approve and eligible required. You get an approve eligible, it would fit Fannie or Freddie and it wouldn't qualify under this program, but approve ineligible is required. Ineligible for loan amount only. And then again, the documentation is per DU and LPA. And if DU and LPA don't address something, we would go to Fannie and Freddie guidelines. And you'll notice we have the June 2020 guidelines listed there. The reason it's June 2020. It's not current guidelines. The June 2020 guidelines are the guidelines that were in effect when the new QM definition was established, and they needed to pick a point in time for guidelines that they knew. The QM definition does allow for current guidelines as long as there are not material changes. But just pointing to the guidelines in effect at the time of the rule makes it easy and avoids any doubt. We do link to those guidelines in our guidelines, so they're available. You don't have to hunt them down. So follow DU and LPA. Use Plaza's guidelines, of course. But if you need to go back and refer to Fannie and Freddie guidelines, we do have a link in our guidelines where you can go get that other income information if needed. Credit and trade lines, we touched on this per DU and LPA. So as long as you get that approved from DU or LPA, you've met the credit requirement for trade lines. And we do offer delegated and non-delegated underwriting on this program, whatever you prefer. A little more on credit, talk about housing payment, mortgage or rent lates, 0 times 30 in the last 2 years for housing lates. Borrowers living rent-free are eligible. We do not require canceled checks to verify that. VOM, VOR, credit report is fine. We only look for canceled checks if there's a non-arm's length type situation. And in terms of major credit events, no BK foreclosure, notice of default or forbearance in the last 7 years. And that would include COVID. If there's any missed payments or any forbearance in the last 7 years, they would not qualify. And regarding missed payments on the mortgage, any missed payments in the last 24 months would not be eligible. More on income and employment. Again, per DU and LPA, can't stress that enough. A stable 2-year history is required, consecutive with no gaps. Limited gaps are allowed per Fannie and Freddie guidelines. That 2-year history is required. DU and LPA sometimes may not require 2 years of documentation. We still want to see the 2-year history, and that's just verified on the verbal verification of employment. So if DU and LPA are looking for 1 year's, tax returns or something, when we do the verbal, we just verify that the borrower's employment history per their 1003 is correct for the last 2 years, just to make sure that they don't have the gaps. We're not verifying the income that whole time. All income must be federally legal. We do require COVID attestation at this time. Won't require that forever, of course. But it's just that the borrower attesting that they don't have any negative impacts on their employment or income as a result of COVID. And we have a link to a sample form in our guides. You can use your own form. Just take a look at our form to make sure they're substantially similar. We do want all those items addressed that are on our form. Standard VVOE within 10 days of the note date. And self-employed, there is that Fannie Freddie overlay. Just want to make sure we point that out because that won't be in the DU or LP findings for the P&L. But we do need that Fannie Freddie audited P&L or an unaudited P&L with 3 months of business bank statements for self-employed borrowers. And again, that'll go away at some point as COVID subsides or those concerns subside. We do need transcripts. So when tax return, for any income used or verified to qualify, we do need tax transcripts or transcripts. If the borrowers only use W-2 income, we do accept W-2 transcripts. We don't need the full tax transcripts in those cases. And we do not need business transcripts. Assets. So assets are eligible per Fannie Mae and Freddie Mac guidelines in terms of which assets qualify. The borrower contribution and gift funds are allowed per Fannie Mae and Freddie Mac guidelines. And again, for a primary residence borrower, they could have all gift funds regardless of LTV. We do follow Fannie and Freddie for that. Regarding reserves, reserves as low as 0 reserves are allowed for loan amounts up to $1 million. We follow the DU and LPA findings for reserves up to $1 million. Loan amounts over $1 million, we need at least 3 months reserves. If the AUS required more, we would do the greater of the two. So it'd either be 3 months or per AUS. And LTVs over 80 require a minimum of 6 months reserves. So this is really nice. Loan amounts up to $1 million, as long as the LTV is less than or equal to 80. Generally, you're not going to require any reserves for that transaction. Now, little footnote down there in the gray. If we could just page back, Tom, thanks. It's always best practice to provide and document as much or as many assets and reserves as the borrowers have and are willing to provide. We're not going to condition for more reserves than our guidelines require. You know, we're not going to give you a hard time if you don't provide more than we require. We only require what we require. But the point here is if there's any questions along the way as we're reviewing the file, if anything comes up, the first place we look is for assets. And if we see significant assets, additional assets, that helps. It helps us get comfortable if we have questions in other areas. So documenting as much as possible in the way of assets is always a best practice. Thanks. So other guidelines, just a few other random things. Max finance properties per Fannie and Freddie. Again, so a primary residence, there would be no maximum to the number of finance properties a borrower may own. Maximum of 2 Plaza Jumbo loans. We allow more than 2, sorry, that should have jumbo in there as well. So we'll allow up to 2 jumbo loans per borrower and up to 4 total Plaza loans. MI is not required regardless of LTV, and escrow holdbacks are not allowed on this program. And that's pretty much it for going through the program, you know, kind of start to finish. Want to just give you a high level overview, introduce you to the program, and just help you understand that it really is different. It's per DU and LPA. The next couple slides we're going to go through, we're going to compare our jumbo programs. Again, kind of give you an idea of what one does and what another doesn't. And also kind of it just really helps illustrate how the Jumbo AUS and how it works. So we have the Jumbo AUS program and the Jumbo One program. So you might wonder which one should I use or which is the best one. In most cases, you could use both programs. Really, if you have a borrower that's able to document income and employment per Appendix Q, and you have no problem getting that documentation from them, really just select which Jumbo program prices best for you, or whichever one you want to do, you know, assuming the borrower has all that documentation available. There are cases where Jumbo AUS works and Jumbo One doesn't work and vice versa. In general, though, I think you'll find that Jumbo AUS is the better program just because it requires substantially less documentation in most cases, easier to qualify in most cases. But really, I guess the message here is many loans would fit both. You can pick the one that prices best in those cases where you have the documentation for either program. Specific eligibility differences. Excuse me. So these are things that our Jumbo One program, the more traditional Jumbo program, allows or does that Jumbo AUS does not do. But I think what you'll see after we go through this list, you'll realize that the typical Jumbo loan would fit Jumbo AUS, no problem. So loan amounts over 2 million, up to 2.5 are eligible on Jumbo One, but not Jumbo AUS. Jumbo AUS caps at 2 million. If you have a high balance loan in a high balance location, we can do that on Jumbo One. Co-ops are allowed on Jumbo One, and Texas cash out transactions are allowed on Jumbo One, not on Jumbo AUS. Again, that 1% cash back. So if you're getting over 2,000 cash back up to 1%, that would qualify on Jumbo One, but not Jumbo AUS. Delayed financing months 4 through 6 are eligible on Jumbo One. Jumbo AUS only allows delayed financing for the first 3 months. Gifts are allowed on both programs, but gifts of equity are not allowed on Jumbo AUS. For properties over 20 acres, Jumbo One goes up to 40 acres, Jumbo AUS goes up to 20 acres. So those are some things that you can do on Jumbo One that you cannot do on Jumbo AUS. But really, other than the things listed here, Jumbo AUS fits everything that Jumbo One does. And you can see your typical single family, purchase rate term or cash out, you know, residential property with no gift of equity, The typical jumbo fits on both programs, no problem. There's just a few things that Jumbo 1 does that Jumbo AUS doesn't, but it's not going to be your typical jumbo that you're doing every day. So that's the end of the guideline piece of the presentation. You know, we went over the program, explained the benefits, went through guidelines, and did a little comparison. Hopefully, after viewing that and listening, you have a better understanding how Jumbo AUS is different. It's really that difference in documentation, and now those non-conforming borrowers that could qualify using Fannie and Freddie guidelines but missed out for the last few years because they couldn't meet Appendix Q. Now there's a program for them, and we're really excited to offer this. So with that, I will turn it back over to Salpy, go over a couple things on our website, and then we can open up for some questions.
Okay, thanks, Rich. So here's our resources. There's several ways. If you have questions in general about this program, you can, the beauty of our website, as you can see here, you just click on correspondent, and it'll take you to a different group of things that you can go to. One being our application, if you're not set up with us, if you're interested in signing up, and also our seller guide and marketing material. So there's lots of information here, whether you're signed up with us or not. And if you go to the seller guide, it'll answer a lot of these questions about this specific product that the Jumbo AUS, but also you could see all our other programs. And so really, if you'll go to the next screen, Tom, back to the marketing materials, different ways to get information here. We have a ton. So all you got to do is go to our website. Like I said, whether you're a correspondent or not, if you are, you can go in through your login. If you're not, you can just do the plazahomemortgage.com, and it'll take you right into that website and pick correspondent lending. And of course, we have our different regions nationwide. For those of you who are in different parts of the country, if you wanted to reach out to them with more questions, here they are. Ricky for the West, Kirk for the Central, Aaron for the Midwest, and Melanie for the East. And if all else fails and you forget all this, you can always reach out to me or Tom, and he'll find me. You know, he knows exactly where to find me. So, but again, if you have any questions, we're here, whether it's today or another time, but we're anxious to tell you guys about this product. We're excited to have it. Rich, you did a great job talking about it. Thank you. I know as a sales side, I'm very happy to have this program for our clients. And then Jason, really, he does all the work for all you guys that need to know on this program. So Rich and I are just here to present. But the thing to remember, delegated or non-delegated are both available for this program and really all our programs that we offer. But just know the non-delegated is there should you need the assistance. So that's all for us, Tom.
Excellent. Well, Salpy, Rich, thank you both so much. As you can see on the screen, just want to point out, obviously, this will be the portion for Q&A here. Reminder that the slide deck and recording links to today's presentation will come out to all registrants and attendees as part of the follow-up. And obviously, if you've got more questions or looking for additional information around Jumbo AUS, or how you get started with partnering with Plaza as your preferred correspondent investor, we've got Salpy's contact information here right on the screen, as well as we'll also incorporate that in part of the follow-up correspondence to the attendees here. So just a reminder, you can use the chat or Q&A function for any questions that you have. We've got Rich that could cover any program guidelines. Jason's got your underwriting related questions covered, and Salpy kind of give you the end all be all related to Plaza. So feel free to drop those in the chat. Got a couple here offhand. Rich, you mentioned a couple best practices going through the guidelines on the call. Anything that jumps out to you as far as the Jumbo AUS program, or originating the loan program outside of just making sure that you're doing a diligent accumulation of assets on the borrower?
Really, it's really as simple as it sounds. You know, it's kind of like maybe the first question should be, is it really that easy? And our answer is yes. It's it's really a simple program. Obviously, you know, do a good job, pay attention to the DU and LPA findings, and document accordingly. And like you mentioned, thanks, Tom, the assets, that really is important. Any assets you can provide is great. You know, however, the guidelines are the guidelines. We're not going to chase down more assets than we require, but just paying close attention to the DU and LPA findings and any asset documentation that can be provided.
Excellent, thank you. And then, you know, not to put you on the spot here, but thinking through the program, I mean, with being able to leverage DU and LPA documentation, Fannie Freddie guidelines, in addition to the ease of use, do you anticipate reduced turn times as well for the processing of a Jumbo AUS loan file?
Yes, and that's a great question. Thank you. You know, and it depends on our customer, the seller, if they're going to choose to do this delegate or send it to us for prior approval. But on the wholesale side, you know, just for perspective, these are getting turned much faster than the traditional jumbo programs. They can get underwritten much faster, decisions out much faster, and on the correspondent side, the purchase process should be much quicker. Absolutely.
Excellent, thank you. And then I've got to imagine with this program, probably does it seem assumptive that you could see a larger uptick in eligible applicants per se versus you know, maybe other industry programs on the jumbo side, or even in comparison to Jumbo One?
Yes, 100%, absolutely. That's not 100% uptick, but yes, it's really two things. It's easy, and it's more people qualify, more borrowers qualify under this program, and it's twofold. It's the slightly expanded matrix with the LTV, FICO, and loan amount buckets are a little expanded compared to a traditional jumbo. And it's really that documentation piece. There's so many borrowers that would have qualified for Fannie and Freddie, but don't qualify under Appendix Q, that'll fit under this program. It's a big difference. I don't have a specific percentage or statistic for you, but we've even seen it on the wholesale side where we've been promoting the program. This program's fivefold more applications than our Jumbo One program. It's just, you know, priced similarly. It's night and day in terms of uptake and eligibility and qualification.
Thank you, Rich. Two more questions quickly here. Selby, you know, because you mentioned it at the onset of the discussion with the certified loan program, is there anything, say, a new client signing up with Plaza would need to do to have their loans covered from the program, or is that automatically put in place, that coverage on any loan that a lender would sell to Plaza?
Yeah, automatically put on loans, closed loans sold to Plaza. That's the beauty of it. You don't have to think about it. We just put it on every loan, and there's no upfront cost, and we don't back off anything in the price or anything to offer that. So we have to compete for your business just like everybody else. But if we win that business and we earn our way to get that, then we will put those on every loan we purchase.
Excellent. Thank you, Selby. Take a look here. You know, I had another question about some of the key points originators should be looking at when determining which Jumbo Plaza program is the optimal fit. But I mean, I think that kind of got covered very well, Rich, in that comparison between the Jumbo One and Jumbo AUS offerings. Obviously, being able to leverage the DULPA documentation and Fannie Freddie guidelines, I think should make it pretty elementary, I guess you will, for clients and kind of determining which program is going to be the best fit for their loan file.
Yeah, you know, every borrower scenario is going to be different. You know, you'd want to look at it and see which program's best for you, but the overlap in the two programs is huge in terms of the matrix, or assuming a borrower comes to you, the customer, with, you know, everything, all the documentation in front of them, they bring everything, and they're a standard loan. Both programs will work fine. it's really about the documentation requirements. You know, if the borrowers qualify for both, but maybe they don't want to go gather, 2 years worth of everything, and you just want to originate the loan using DU and LP, it really reduces the cost to originate too. You can use different underwriters if you're running DU and LP, looking at guidelines, instead of an underwriter that's fully manually underwriting a file, having to go to Appendix Q, do all that work. It's just much easier on this program, and I guess it depends what's important to you as the originator. On a particular scenario, is it price, or is it which program you can do faster or easier? They both work. This program's just easier, faster, and has a bigger qualification bucket.
I mean, those are great traits right there. And Rich, I'm so glad you pointed out the the potential cost reduction to originate the loan too. I mean, that's always extremely important to really lenders of any size or origination channel, and trying to keep those costs down and maximize profitability as well. So appreciate you mentioned that. On that note, I don't have any additional questions offhand. So once again, I want to thank Selby, Rich, and Jason for hanging out, looking great with us, and sharing valuable insights today. And our attendees as well for taking the time out to join us. And just a reminder here, we'll have more information for you to be able to connect direct with Plaza and learning more on how you can partner with them and be able to take advantage of this exciting new program offering. So thank you each again for helping lead us today, and I hope you all have a great afternoon.
Thank you, Tom. Thank you, guys.
Yeah.
Thank you.
All right, bye, everyone.